Hi everyone, welcome back to the Traveling Traders. My name is Paul. It is now Sunday, the 12th of March, here where I am in New Zealand, and I have my charts open trying to figure out the game plan for tomorrow. And boy, if you watched my last video, I was saying that we could expect a wild ride, some volatility this week, and did we get that? Wow! And we expected it to be all from Jay Powell's testimony, really, to cause that volatility. Who would have thought that by the time the week ended, we would have the second largest bank collapse in US history? And so all sorts of things can be on the cards for tomorrow. It can be a very dangerous time for traders. Fortunately, I've got about 10 years under my belt, seen this before. And so there are three key things that I want you to remember for tomorrow if you're going to trade the market tomorrow. Three key things that can help you just protect your capital, make good money, give you the best possible chance of success. And let's dig in. I want to share that with you today. So first things first, let's just have a look at where we're at in the chart right now. This is the NASDAQ futures that we're looking at. So the MNQ, the 03 contract, so 60-minute chart. And we said that we can expect a wild ride. We had quite the run up over there starting on the 3rd of March, but then only for it to say, no, we're going back down again. So the question now becomes, where are the Elliott wave patterns right now? The waves, I have them marked up on the screen. And you can see we've got a nice 1, 2, 3 wave set up. I'm looking for a wave 4 in order to sell it back down to complete a wave 5. As you guys know, I like to trade wave 5 to sell it back down or buy it back up again to retarget the low. That's going to be the trade that I'm looking for tomorrow. So let's just see if it follows all of the rules first, right? What are the rules of Elliott wave theory to make sure that we are on the right track? So if you look at wave 1, you can see we know that there are waves within waves. There is 1, 2, 3, 4, 5. That makes up wave 1, followed by a correction. Now the correction needs to be right there. Look at the correction zone. It got there beautifully. We are on the right track. And now that we saw that, we can start making some targets. Where would wave 3 want to go, which I have marked up nicely on the screen for you guys? And have a look. We have waves that's gotten back down. Now, as you can see, it got to the 100%. In other words, that is the length of that wave 1 is the same as the length of that wave 3 over there. Technically, wave 3 just needs to be longer than wave 1 because wave 3 can never be the shortest wave. For recap and to learn all of the Elliott wave theory that we apply to the market, don't forget I've got a free video course. It's all free on the website, thetravelingtraders.com. Just sign up there. No credit card details needed, nothing. Just it'll change your day trading career to understand the Elliott wave theory. But now, because we have gotten there, we know that the wave 3 is longer than wave 1. We are on the right track. And we also know that the market likes to pull back about 38.2% the length of wave 3 in order to sell back down. So if we consider there was the target for wave 3, which it got to beautifully, I might add. But now let's just see, because of that little pullback that happened there, I'm curious to know, why did it turn around there? Well, if we look then at our Fibonacci retracement of that wave 3, it got to the 38.2% beautifully, and it sold back down to get to the wave 3 target. We are on the right track. All of this is to say, we can now look and expect to have a bit of a pullback. Until where? Where would we want to sell this back down? Couple of things. Number one, let's just see if this is the entirety of the completed wave 3. I do not like that pullback having happened there, but there it is. It's very likely that a lot of sellers will be waiting now to get back to the 38.2% of that wave 3 move down in order to sell over there, to sell it back down again, looking for that area. Combined with that, we've got some channeling at play. I've taken the low of wave 1, connected it to the low of wave 3. That channel you can copy and paste to the high of wave 2. bring it back down, and it'll be very nice to see some confluence there of selling that channel along with the 38.2% to sell it back down. That is the ideal plan that I'm looking for. However, the markets are volatile right now. There's a lot that can be happening tomorrow. We've had so much news over the weekend with USDC is depegged. Silicon Valley Bank has gone and imploded in on itself and is no longer with us. And there are so many depositors there, tech companies especially, that have millions and millions of dollars loaded up in that bank. How are they going to make payroll this week? That's the question I want to know. So there could be another bloodbath coming on the wave down. But if experience has told me anything, is that, anything can happen. We've also got an emergency closed door meeting tomorrow of the board of the Reserve Bank. And who knows what they're going to come up with. Are they going to come up with a bailout for Silicon Valley Bank? In which case, this thing could rip higher just on the good news. Or they could just say, no, the market doesn't care. It could just rip back down. So this is where risk management and certain trading rules become very, very key. What I would suggest, please do not fall into FOMO tomorrow. That is rule number one that I'm telling myself for tomorrow is no FOMO. FOMO, it means the fear of missing out. Because of what's going on out there, because of the volatility right now, it's very tempting to think, oh well, when the market opens on Monday, this means that it's just going to tank back down. A lot of people are expecting that it can just tank back down. Now look, unless you have the kind of capital in your account to trade with that can absorb a lot of volatility, that can absorb a lot of risk, just blindly selling at the market open tomorrow might not be the best idea, or unless that is in your plan. If that's the way you like to trade the market, then go for it. However, please do not have this fear of missing out syndrome tomorrow. Trade your plan, which comes then to rule number 2 that I'm going to follow for tomorrow is take out your written trading plan. Read it and then read it again just to make sure that you're still going to follow your trading plan tomorrow. Just because we've had all this volatility and all of this news, it doesn't mean that you should be tempted to have the trade of your life to go make millions. I can guarantee you a lot more people can lose money, big money in these volatile markets than the small number of people that can end up on the evening news who went and made millions on the trade of a lifetime. We do not want to go into a situation where we have one trade that can set us up versus 99.99% of trades out there in that situation that can actually just tear up our account. We do not want to have one trade define us. We want a trading career, not a one-hit wonder. Please take out your trading plan, read it, make sure that you follow it for tomorrow. For me, my trading plan is Elliott wave. I'm still looking for the waves. I'm still following my plan. Nothing is going to change. Lastly, this brings me now to my rule number 3 that I'm going to be following for tomorrow, and that is I'm going to adjust my risk tolerance into a more conservative posture because of the volatility out there. So as you guys have probably picked up, I like to swing trade, and I'm swing trading the micro futures, and I'm doing it on a relatively small account because I'm wanting to demonstrate to people out there how even on small accounts you can be very consistent. So I like to trade with every $3,000 that I have in my trading account. I personally like to trade one contract. However, because of all of the volatility right now, I'm going to increase this to $5,000. So for every $5,000 in my account will equate then to one contract. I am decreasing my risk tolerance. I'm going to take a more conservative posture because if this market just rips against me tomorrow, if I'm looking for a sell and it rips against me, I want to continue to sell. The problem is, when you have this kind of volatility, if there are going to be more sellers than buyers in the market or more buyers than sellers, you can have a stop loss someplace in the market, and you can find that if the market is too volatile, it just rips past of your stop loss and you can take more of a stop out than what you planned or bargained for. This is how accounts can get blown. So the 3 rules: do not fall into FOMO. take out your written trading plan and read it and make sure that you follow it. And number 3, adjust your risk tolerance into a more conservative posture for tomorrow. But just to recap, I'm looking for waves 1, 2, 3. I'm now looking for wave 4 to correct at the 38.2% down line of that down wave 3 in order to sell it back down again. I'm just looking for 1% return on my capital for tomorrow. Just 1%. If I make that, I switch my laptop off and I go home smiling all the way to the bank. And so with 1%, all I need is 100 ticks out of the market tomorrow, and that is a successful day. All I need is 100 ticks, which is the size of that box. All I need. So I'd love to hear more from you. Like and subscribe if you got any value out of this today. I look forward to hearing from you guys. And again, watch my trading videos, my tutorials on the website at thetravelingtraders.com. I'll see you guys soon. Cheers.